Welcome to Breaking News to Trading Moves.
Today we're examining the market's reaction to the latest DoorDash earnings. That's ticker DASH.
Yeah, we've got quite a bit of analysis here covering their Q3 performance.
And importantly, what the predictions are saying about who might benefit and who might feel the pressure. We're looking across delivery, restaurant tech, the whole ecosystem, really.
Right. Our purpose today is to work through these materials, figure out which parts of the economy might see an uptick or maybe a downturn based on what DoorDash, as the category leader, has signaled about its strategy.
In this particular report, it's a really good example of market dynamics, isn't it?
How so?
Well, you see this strong performance right now, operational speaking, but that gets overshadowed completely by their plans for future spending.
That tension, that's exactly what we need to explore. So DoorDash did well on operations.
Oh, yeah, very well. They beat expectations on total orders, revenue too.
Okay.
And on gross order value, GOV, that's the total value of everything ordered on their platform.
So the core business is humming along. People are ordering more.
Definitely. It confirms that the move to off-premise dining is still going strong. Growing fast, actually.
So, on the face of it, a great quarter. But the market didn't like it.
Nope, negative reaction.
Okay, let's focus right there then, this contradiction. Strong current results versus future spending plans. Why did the stock drop if the GOV numbers look good?
Well, the first clue was the miss on earnings per share, EPS.
Ah, okay. So profits weren't quite there.
Exactly, which hints that margins were already a bit tight. But the main reason, the big one, was the announcement about spending.
Specifically.
They flagged substantial increases in tech and product spending, specifically planned for 2026.
2026, that's quite far out.
It is, but the market interpreted it as a clear signal, a promise almost of lower margins for years to come, sustained pressure.
So investors saw the Q4 guidance for GOV, which was strong, confirming growth is actually accelerating.
Right.
And they still zeroed in on the cost of that future growth.
That's it, exactly. Management is signaling a strategic choice here. They're choosing to reinvest heavily now.
Sacrificing near-term profits.
Precisely. To build out their competitive advantage, solidify their market position for the long haul.
It's a classic growth stock dilemma then. Investors wanting profits now versus management playing the long game, aiming for dominance.
Yeah, they're prioritizing market leadership over the next few quarters' net income figures.
Okay, that takes us right into decoding the DoorDash strategy itself. If they're planning this big spend in 2026, where's the money actually going? What's the plan?
It looks pretty strategic, actually, focused on three main areas.
3 areas, okay.
And these seem designed to push them beyond just restaurant delivery towards being a broader global logistics platform.
Let's take the first goal then. What is it?
Goal 1 is platform unification. They specifically mention integrating their big European buys, Wolt and Deliveroo.
Right, I remember those acquisitions. So integration, that's more than just changing some logos, I assume?
Oh, much more. When you buy two large, separate tech platforms, the real work, the real cost, is merging the underlying technology, the architecture.
That sounds incredibly challenging. What makes it so tough technically? Why does it justify looking ahead to a big spend in 2026?
Well, think just about the different operating environments. Wolt is big in Europe, right? Different data privacy laws, different labor rules, tax regulations. Compared to the US or Deliveroo's main markets, the tech stack has to handle all that seamlessly.
So building one system that complies everywhere.
Yeah, and standardizing everything. Ordering systems, payment methods, the algorithms for pricing, for driver routing across continents.
It's like building a single global brain for the whole operation.
That's a good way to put it. If they pull it off, they get huge efficiencies, remove duplicated effort.
But the cost of getting there.
Yeah.
Migrating users, merchants, replatforming engineers, that's the massive spend.
That's the spend. And there's risk. If it takes too long or doesn't go smoothly, they could be vulnerable. But the aim is clear. One powerful global unit to launch new things faster.
Yeah, that makes sense. What's the second major investment area?
Second area is expanding autonomy initiatives. They mention specific pilots.
Autonomy. Robots. Drones.
Potentially, yes. This isn't just science fiction talk. It's a direct attempt to tackle the biggest variable cost in delivery.
Labor.
Right. Driver pay is always the challenge for unit economics, isn't it?
Always. So what form does this take? Well, the analysis points to things like smarter AI for routing, making sure drivers are carrying orders efficiently, not driving empty.
Optimizing routes, batching orders better.
Exactly. But also the more forward-looking stuff, investing in last-mile solutions like sidewalk delivery robots in certain urban areas,
Ah.
or maybe drone delivery for suburban routes.
Okay, but that brings in a whole other layer of complexity, right? Hardware, software, plus regulations for autonomous vehicles in public spaces. Absolutely, and that's why the investment is needed. They have to run pilots, prove the models work, navigate the rules.
So the goal is, if a robot or drone can handle short, high-volume deliveries.
It takes a human driver out of that specific loop, lowering the cost per delivery significantly in those markets.
It's a structural attack on the labor cost problem.
That's what the spending signals. Yes. Trying to solve it fundamentally, not just by tweaking driver pay up or down.
Okay, platform unification, autonomy. What's the third goal?
Third goal, adding new services and product offerings.
Expanding beyond restaurants.
Definitely. Pushing DoorDash Drive further, that's their logistics service for other businesses, retailers. Launching new categories, maybe flowers, alcohol where it's legal.
Broadening the scope.
And potentially even building out more financial services for their merchants beyond just processing payments. Maybe things like working capital or better analytics tools.
So, becoming indispensable. Not just for dinner, but for all sorts of local logistics. Maximize utility for consumers, lock in merchants.
It's about capturing more consumer activity, funded by accepting lower margins for a while. The strategy confirms they see themselves as the leader, and they're hitting the accelerator.
And you mentioned this spending doesn't just impact DoorDash and its direct rivals.
Right, this is key. When the biggest player invests this heavily, it tends to lift the tide across the whole ecosystem. More volume overall in delivery and restaurant tech.
So even if DoorDash's stock takes a hit now because of margin concerns,
The sheer scale of the planned spending acts like stimulus for related industries.
in a way, yes. It reinforces that fundamental move towards off-premise consumption. You see evidence in their ongoing deals, too.
Like what? The partnership with Kroger, for example, doing grocery delivery, or the deals with big chains like Domino's. It shows DoorDash embedding itself deeper into retail and food supply chains.
They're becoming the go-to facilitator for moving spending from physical stores to digital, off-premise.
That's the picture emerging.
Okay, this sets up the next part perfectly then. If DoorDash is spending billions to drive activity and build out logistics, that creates opportunities. Let's talk about the projected winners. We need to be really clear on why each group benefits. What's the mechanism?
Agreed. Let's start with category 1, restaurant tech and ordering platforms. Companies like Toast, ticker TOST, and Olo, ticker OLO.
Okay, 2OST and Olo. The logic seems straightforward. More DoorDash orders mean more transactions for these platforms. But can you break down how that cash flow works? How does DoorDash's GOV growth translate to revenue for Toast and Olo?
Think of them as the plumbing or the operating system for restaurants, especially in the digital age. They make money from the complexity and volume that DoorDash drives.
Let's take Toast, TOST first. They do a lot right. Point of sale, payments, even payroll.
Exactly. They're quite integrated. So when DoorDash volume goes up, Toast wins in several ways. First, the restaurant is paying a subscription for the Toast POS system itself.
Okay, basic subscription fee.
Second, Toast processes payments. So they get a piece of the total payment volume, TPV, on orders, whether they start in the store or come through DoorDash. More delivery volume means more TPV processed by Toast.
Right, more transactions flowing through their payment system.
And third, Toast sells specific add-on modules, things like their kitchen display systems, KDS, which help restaurants manage all those incoming orders. More DoorDash orders means kitchens need those tools to cope.
So higher DoorDash volume makes those extra Toast modules more valuable, driving up the average revenue Toast gets per restaurant.
Precisely. DoorDash's growth increases the restaurant's reliance on Toast's whole system to stay efficient. It's embedded in their financial and operational flow.
Okay, that's Toast. What about Olo? Ticker Olo. They're more focused on big chains, aren't they?
Yes, Olo specializes in software for large, multi-location restaurant enterprises.
And their role is more about integration, connecting the dots between DoorDash and the restaurant's own systems.
That's right. Olo provides critical software, like their dispatch product. When you order from a big chain on DoorDash, often it's Olo's software managing how that order gets into the restaurant system and coordinating the delivery logistics.
So as DoorDash signs up, more big enterprise clients.
That directly benefits Olo, because many of those chains use Olo to manage their digital orders. More delivery volume equals more fees per order handled by Olo's platform.
So DoorDash brings the fire hose of orders, and Olo provides the essential software nozzle to direct it smoothly into the kitchen.
It's a symbiotic relationship. The volume and complexity DoorDash generates make services from Olo and Toast more essential, providing them with transaction-based revenue growth.
Okay, that covers the tech infrastructure. Now, what about the places actually making the food? Category 2, quick service and delivery-friendly chains. You mentioned Chipotle, CMG, and Wingstop, Wing.
Right. CMG and Wing. The thinking here is about operational fit. These chains are just better set up to handle the kind of demand DoorDash generates.
Better set up than, say, a traditional sit-down restaurant.
Exactly. When DoorDash ramps up marketing or offers promotions, there's a surge in orders. These QSR chains are built to handle that surge.
How so? What's the mechanism?
It's about how they're built. Take Chipotle, CMG. They've invested a lot in things like dedicated digital make lines.
Separate production lines just for app and delivery orders.
Yes. So those orders don't interfere with the customers standing in the main line. It keeps things flowing.
Minimizes bottlenecks. Allows them to handle both types of demand at once.
Right. And think about things like the Chipotlane, their drive-through window just for picking up mobile orders. The physical store is designed for quick aggregator handoffs.
So DoorDash brings the demand.
And Chipotle's operational setup means they can actually fulfill it efficiently and capture those sales.
And Wingstop, Wing, seems like an even more obvious fit. Their whole model is basically takeout and delivery, isn't it?
Pretty much. Wingstop, Wing, is fundamentally a delivery operation. Simple menu, kitchens designed for high-volume production for off-premise.
What percentage of their business is off-premise?
Often way over 80% based on reports. So any investment DoorDash makes to grow the overall delivery market directly benefits Wingstop's core business. They don't have the baggage of a large dine-in operation.
They don't have to worry about losing high-margin drink sales or the experience factor being diluted because that's not their main game.
Exactly. Their model is already lean and mean, optimized for delivery packaging, pricing, throughput. They're perfectly positioned to grab a large share of any extra demand DoorDash creates.
Okay, tech platforms, delivery-focused chains.
Yeah.
What's the third group of winners? Category 3, fintech enablers of delivery spend. You mentioned Marqeta, MQ, and Block.
Yeah, CFU. This is about the money flow itself. Every order, every payout to a driver, every related expense, it all involves financial transactions. More DoorDash activity means more payment volume for these fintech players.
More GOV translates to more TPV, total payment volume, for the enablers. How does Marqeta, MQ, fit in? Their specialty is card issuing, right? Yeah.
Correct. Marqeta provides APIs, basically tools, that let companies like DoorDash create and manage payment cards programmatically. Virtual cards, physical cards.
And DoorDash uses these. How?
Primarily for drivers paying at restaurants that aren't fully integrated into DoorDash's system. Think of an independent pizza place. The driver might use a Marqeta-issued card funded just in time with the exact order amount to pay.
Ah, okay. So as DoorDash expands, especially into new areas like retail or adding more non-partnered restaurant,
they need more of these card transactions to fulfill orders. That means more card usage, generating processing and interchange fees for Marqeta. They're enabling the money movement, especially for order fulfillment costs.
Got it. And Block, the SKU. They have a couple of angles here with their Square ecosystem for merchants and Cash App.
Block is definitely involved on the merchant side. Many smaller restaurants use Square's point-of-sale systems. When DoorDash sends an order to one of those restaurants, Block, via Square, processes the payment and collects a fee.
So DoorDash's growth drives payment volume through Square terminals.
It certainly does. And then there's the driver side. Many gig workers, including delivery drivers, use tools like Cash App for receiving their payouts, managing tips, and their general finances related to gig work.
So as DoorDash pays out more to its growing driver base,
platforms like Cash App see increased activity, increased flows. Block benefits from the higher velocity of money throughout the whole gig economy labor market that DoorDash fuels. The financial plumbing gets used more.
that really does cover the beneficiary side well. DoorDash's spending essentially fuels growth for the tech backbone and the most operationally ready food providers.
But now we have to look at the other side of the coin. Section 3, projected losers. Where does DoorDash's aggressive strategy create pressure or potential harm?
Let's start with the most direct group. Category 1, competing delivery platforms. The rivals, like Uber, ticker UBER, and Instacart, ticker CART, from Maple Bear.
Right, UBR and CART. The rationale here is pure competitive dynamics. When the leader signals a big, sustained investment push.
Rivals have to react, right? They
Yeah.
can't just stand still.
Exactly. They're almost forced into a costly defensive posture. They need to protect their market share, their driver supply. DoorDash spending heavily on tech, on global integration. It compels rivals to increase their own spending.
On what? Incentives. Marketing.
Both. Driver incentives to keep them loyal, customer promotions to maintain order volume. This directly hits their own near-term unit economics, their margins.
You mentioned earlier the market reaction to Uber's own Q3 report was mixed, contributing to a sense of fragility.
Yes, that was noted. While Uber, UBE, has its ride-sharing business, the Uber Eats segment faces the same intense margin pressures as DoorDash.
So when DoorDash announced its big 2026 spending plan,
The market read it as confirmation that delivery profitability requires this constant, expensive battle for scale and efficiency. It casts doubt on Uber Eats' path to easy, stable margins, even if other parts of Uber are doing well.
it's seen as a perpetual arms race funded by sacrificing profit.
Yeah.
And Instacart, cart, they're mainly grocery, but still under pressure.
Absolutely. DoorDash is making clear moves into retail and grocery logistics. Remember that Kroger partnership.
Right. They're using deals like that to push into Instacart's core turf.
Precisely. Instacart's strength is its shopper network and tech built for complex grocery orders. But DoorDash's war chest implies they can potentially subsidize grocery delivery, competing hard on price and speed.
And grocery delivery already operates on thinner margins than restaurant food, doesn't it?
Generally, yes, it's more price sensitive. So if Instacart cart has to spend more on tech or promotions to match DoorDash, it puts even more strain on their profitability.
So DoorDash's spending effectively raises the cost of playing in the entire last-mile delivery game for everyone.
It makes it harder and more capital intensive for competitors to achieve or sustain profitability.
Okay, moving beyond direct competitors. Category 2, casual dining, dine-in heavy chains. Names like Dine Brands, ticker DI, and Brinker, ticker EAT. They aren't logistics players, but they're competing for dinner spending.
Yes, din and eat. These chains face what looks like a structural headwind, and DoorDash's strategy just makes it worse for them.
How so?
The core issue is cannibalization. The convenience and increasing promotion of off-premise dining, powered by aggregators like DoorDash, pulls customers away from traditional sit-down meals.
We often hear about lost sales of drinks or desserts, which are high margin. But is there a deeper operational impact?
There is. It's multifaceted. First, yes, you lose those high-margin add-ons, alcohol, sodas, appetizers, desserts. People just order the main course for delivery, usually.
Okay.
But also, think about the kitchen flow. A casual dining kitchen is set up for a certain rhythm appetizers, then entrees, paced by tables turning over.
Right, a structured service model.
When a flood of delivery orders comes in, it disrupts that rhythm. It creates log jams, potential for errors, stresses the kitchen staff.
So they're forced to use kitchen capacity and staff time on these delivery orders, which are often lower margin.
And that takes resources away from serving the potentially higher margin customers sitting in the dining room. Plus, they have new costs.
Like packaging.
Good quality packaging costs money, and it's essential to keep food decent during delivery. That's a direct hit. And then there are the commission fees paid to DoorDash or Uber Eats.
So operational disruption, packaging costs, lost high-margin items, plus commission fees, it all adds up.
It really erodes the profitability for chains that rely on the full dine-in experience.
Right.
Think about Dine Brands, DIM, that's Applebee's and IHOP, or Brinker, ET, which owns Chili's.
These brands sell the atmosphere, the service, the whole night-out experience as much as the food.
And when the meal goes off-premise, that key differentiator just vanishes. They become just another food option competing on convenience and price where the delivery players are strong. DoorDash's push accelerates this shift away from traditional dine-in traffic.
Okay, that makes sense. Finally, Category 3, margin-sensitive gig economy peers. This sounds like more of a sentiment issue. You mentioned Lyft, ticker LYFT.
Yes, LYFT. The rationale here is about how market skepticism spreads. Investors see DoorDash planning for lower margins due to heavy spending.
And they apply that same concern to other companies with similar business models.
Exactly. It's less about direct competition, more about perceived fragility in the whole gig economy model, which relies heavily on contractor labor and continuous tech investment.
So DoorDash is the leader, and they say they need massive spending in 2026. Investors look at Lyft, LYFT.
And they see similar challenges. Managing a huge driver workforce, facing intense competition from Uber in their case, needing ongoing tech development.
The assumption becomes, if DoorDash has to sacrifice margins for dominance, Lyft probably does too, maybe with less market power to support it.
Correct. That negative read-through creates concern about the long-term margin potential for the whole group. Plus, there's an indirect link through labor. Lyft competes for the same pool of drivers as DoorDash and Uber Eats. If delivery platforms raise driver incentives significantly, Lyft might feel pressure to adjust its own pay structure to keep enough drivers on the road, impacting their economics.
And the analysis also mentioned suppliers to DoorDash feeling pressure.
Yeah, that's a potential secondary effect. If DoorDash is committing billions to tech, they'll likely look for savings elsewhere.
Squeezing suppliers.
Potentially. Any supplier without much pricing power, maybe providers of packaging, certain software services, administrative support, could face pressure from DoorDash to lower their costs. It contributes to a general sense of caution around companies tightly linked to the gig economy's cost structures.
Wow, okay. This has been a very detailed walkthrough of the potential consequences stemming from that one DoorDash report. We've traced the lines from their spending plans to the tech enablers like Tosa and Olo, the efficient QSRs like CMG and Wing.
And then contrasted that with the pressure faced by competitors like Ubi and Cart and the structural challenges for dine-in chains like Din and Eat.
Plus, that broader sentiment impact on peers like LYFT.
So putting it all together, what does this analysis suggest for you, the learner?
Well, the DoorDash situation is really a classic case study. It highlights that tension between investing for long-term strategic growth and delivering immediate financial results.
A major strategic commitment from the market leader.
Right. A commitment that aims to accelerate growth but comes with near-term margin pressure. And that decision sends waves, both positive and negative, through the entire vertical. It boosts the underlying infrastructure providers and the best-suited restaurants,
while forcing costly reactions from direct rivals and further challenging traditional business models.
Exactly. And at the heart of this, the big spending item causing the current market anxiety is that plan to unify their global tech platforms, Wolt and Deliveroo.
We talked about the cost implications of that integration.
We did. But think about the longer-term competitive angle here. Consider the risk and reward embedded in that specific strategy.
What do you mean? Well, how will their success, or maybe failure, in actually merging those huge different technology platforms reshape the global logistics game 3, 4, 5 years from now?
If they pull it off.
If they achieve true global operational synergy, the cost for Uber, for anyone else trying to compete globally, goes way up. It becomes exponentially hard.
But if they stumble,
yes,
if the integration proves too complex or costly,
then that massive investment becomes a major drag, a significant vulnerability. That's the big strategic gamble underlying this whole situation.
a gamble that will definitely influence the future of delivery.
Without a doubt.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.